Good day, ladies and gentlemen, and welcome to the Investors Trading Academy lecture series. And this series is on the financial markets and learning to understand them so that you can eventually trade in them. This lecture consists of 9 classes or 9 lectures. And you will start off learning the basics of the financial markets and then move on to learning and understanding technical and fundamental analysis and how to read charts. And from there, we'll move on to trading and making smart decisions. And then each lecture will prepare you to slowly move through to give you the basis and education that most new traders don't have. They come to start trading or investing in markets and don't want to learn all the basics, so they eventually end up making big mistakes because they don't understand all the ins and outs. And in this 9 series, we're going to make sure you have a solid education. Now, I would appreciate if you would make sure you took the lectures in order. Okay. I'd also appreciate greatly if you would subscribe to my YouTube channel or just hit the bell icon down below, because your subscriptions are very important to us. Now, this is lecture 2 of the 9-part series. So after this lecture, you have 7 more to go. If you didn't see the one, then you missed the first one. So let's dive into class number 2, financial assets. Financial markets are a type of marketplace that provides an avenue for the sale and purchase of assets such as bonds, stocks, foreign exchange, and derivatives. Often, they are called by different names, including Wall Street, capital markets, but all of them still mean the same thing. Financial transactions channel funds from investors who have an excess of available funds to issuers or borrowers who must borrow funds to finance their spending. Simply put, businesses and investors can go to the financial markets to raise money, to grow their business, and to make more money respectively. The financial markets comprise of 5 key components. We have the debt market, the equities market, the foreign exchange market, the mortgage market, and the derivatives market. And you have to understand that these 5 components all function separately, but do have a relationship to each other. From the 1980s, each component market has been expanding in size, and an extensive array of new financial instruments have been initiated, especially in the mortgage market and the derivatives market. Just think, the forex market wasn't traded online in the 1980s. We didn't have such things as CFDs, and we sure didn't have cryptocurrencies. Now, one of the biggest markets is called the debt market, or debt instruments. And debt instruments are traded in the debt market, or often referred to as the bond market. We more or less hear from them all the time as bonds. I want to buy bonds, I sell bonds. But bonds are actually debts. The government or the company that is issuing a bond is borrowing money to repay it at a specific time, in a specific way, with specific interest. The debt market is important to economic activities because it provides an important channel for corporations and governments to finance their operations. Interaction between investors and borrowers in the bond market determines interest rates. The size of the world bond market was estimated at 37 trillion at the start of 2002. Okay. It's now over 100 trillion in 2020. Bonds are denominated in dollars currently, representing roughly half the value of all outstanding bonds in the world. Equity instruments, or the equities market, are traded in the equities market, also known as the stock market. The stock market is the most widely followed financial market in the United States and mostly in most major developed countries. It is important because fluctuations in the stock price affect investors' wealth and hence their savings and their consumption behavior, as well as the amount of funds that can be raised by selling newly issued stocks to finance investment spending. The size of world development equity markets expanded from 892 billion in 1974 to 25, I guess it's actually trillion, 276 billion by the end of 2001, with the US market accounting for 57%. Now, in 2020, it is almost 10 times that value. Then we go over to the foreign exchange market. And the foreign exchange market are where currencies are converted so that funds can be moved from one country to another. Activities in the foreign exchange market determine the foreign exchange rate, the price of one currency in terms of the other, and the volume of the foreign exchange transactions worldwide averages $5 trillion daily. That's daily per day. Then the other market type is the mortgage market. And a mortgage is a long-term loan secured by the pledge of real estate. So it's a very broad market. Any type of loan with a pledge of real estate is considered part of the mortgage market. Mortgage-backed securities, or also called scrutinized mortgages, are securities issued to sell mortgages directly to investors. Now, investors aren't you and I, it's investment banks, and they're big accounts and they're big funds. The securities are secured by many mortgages packaged into a mortgage pool. Now, most of us didn't even know anything about this until we had the mortgage crisis of 2008, when we heard about all these scrutinized mortgages and all these foreclosures, but nobody having the paperwork and nobody actually knowing who owned the mortgage. The most common type of mortgage-backed security is a mortgage pass-through, a security that promises to distribute to investors the cash flows from mortgage payments made by borrowers in the underlying mortgage pool. A 1980s innovation in the mortgage-backed securities market has been the collateralized mortgage obligation, or CMO, a security created by redistributing the cash flows of the underlying mortgage pool into different bond classes. Mortgage-backed securities have been a very important development in the financial markets in the 1980s and 90s. And then we go over to the derivatives market. Financial derivatives are contracts that derive their value from the underlying financial asset. Derivative instruments include options contracts, future contracts, forward contracts, swap agreements, cap and floor agreements. So there's a huge amount of derivatives. Derivatives can be simply explained as they derive their price from the underlying value of an asset. These instruments allow market players to achieve financial goals and manage financial risk more efficiently. Since the introduction of financial derivatives in the 1970s, markets for them have been developing rapidly. Now, the top three types of contracts are equities indices, interest rates, and individual equities, are all financial derivatives. Together, they account for 88.7% of the total contract volume. Most of these are things that we don't, as a general public or retail investor, never know about and never have access to. So how do we classify the financial markets? Well, there are so many financial markets. Every country is home to at least one, although they vary in size. Some are small, while some others are internationally known, such as the New York Stock Exchange, the Dow Jones, or the London Stock Exchange, and they trade trillions of dollars daily. So these markets or exchanges are made up, number one, the stock market. We all know about the stock market. It refers to the equities market before. The stock market trades shares of ownership of public companies. Each share comes with a price, and investors make money with the stocks when they perform well in the market. It's easy to buy stocks. The real challenge is choosing the right stocks that will earn money for the investor. There are various indices that investors can use to monitor how a stock market is doing, such as the Dow Jones and the S&P. Now, we can't get indices mixed up with stocks. Indices are collections of stocks, and their price values should have a reflect on the overall market. When stocks are bought at a cheaper price and sold at a higher price, the investors earn money from the sales. Now, let's explain the bond market, or the debt instruments. The bond market offers opportunities for companies and the government to secure money to finance a project or investment. In a bond market, investors buy bonds from a company, and the company returns the amount of the bond within an agreed period plus interest. Commodities market. The commodities market is where traders and investors buy and sell natural resources or commodities such as corn, oil, meat, and gold. A specific market is created for such resources because their prices are unpredictable. There is a commodities future market wherein the price of items that are to be delivered at a given future time is already an identified, sealed today. In the commodities market, everything that is there is consumed or used. So there is an ultimate end goal, but speculators in between buy and sell commodities to make money on the price movement between the time that they are grown, produced, or available and the time that they are to be delivered. And then we come to the derivatives market. Such a market involves derivatives or contracts whose value is based on the market value of the asset being traded. The futures mentioned in the commodities market is an example of a derivative. And then we come to the newest and growing market is cryptocurrencies. Cryptocurrency exchanges are websites where individuals can buy, sell, or exchange cryptocurrencies for other digital currencies or traditional currency. The exchanges can convert cryptocurrencies into major government-backed currencies and convert cryptocurrencies into other major cryptocurrencies. Cryptocurrencies are digital assets that use cryptography and encryption technique for security. Cryptocurrencies are primarily used to buy and sell goods and services, though some newer cryptocurrencies also function to provide a set of rules or obligations for its holder. They possess no intrinsic value in that they are not deemed redeemable as a commodity such as gold. Unlike traditional currency, they are not issued by a central authority and are not considered legal tender. Certain cryptocurrencies can confer other benefits on holders, including limited ownership and voting rights. For example, a cryptocurrency funded organization can include voting rights in the currency software code. Or cryptocurrencies could also include fractional ownership interest in a physical asset such as stock or real estate. Now, how do they work? Well, they're mined. Mining refers to the step whereby two things occur. Cryptocurrency transactions are verified and a new unit of the cryptocurrencies are created. Effective mining requires powerful hardware and software. When it comes to verification, an individual computer isn't powerful enough to probably mine cryptocurrencies because you run up your power bill. To address this, miners often join pools to increase collective computing power, allocating miner profits to participants. Groups of miners compete to verify pending transactions and reap the profits. So that's a wrap for today. So right now you should have a pretty good understanding of the overall financial markets or the individual sectors of the financial markets, because too many people get all wrapped up in their trading forex and they don't realize all these other markets are out there existing. They kind of know some of them from the paper, but we're going to start to learn how one market can drastically affect the other market and how a move in forex values can affect the commodities price immediately, whereas that commodities price can affect the value of a share and how that share's value can affect the bond market. Okay, because they all flow together, and when you understand how all these markets flow together, you can make better trading and investing decisions. So that's a wrap for today. Thank you very much for joining us, and we'll see you for lecture number 3. Bye now.